Welcome to Personal Financial Management. This is week 6, and I'm your online instructor, Diana Block. And this week we're going to talk about mortgages. And out of the material that you're going to cover in this last week, I thought mortgages was the most important topic because it is such a large portion of most people's monthly spending. If you have a mortgage, that's normally your largest bill. And even if you rent, your housing is pretty much always your largest bill for the month. And with a mortgage, you're committed for a long time in that property. So I thought that was the best topic to talk about to make sure we understand what's involved with mortgages. So that's what we're going to talk about here. So let me go ahead and explain the different components of a mortgage. A lot of times people are surprised at the payment amount of their mortgage because they think, well, okay, the house costs $150,000 and I'm going to pay on it for 30 years. So if I divide that by 30, and then that's my payment. No, there's a lot more involved in the cost of the monthly payment of your mortgage besides just the actual price of the house. The actual purchase price of the home is your principal. So that's the principal that you have borrowed. That's the amount you've actually borrowed from the bank, the original amount that you owed. And the bank is going to decide how much they're going to actually lend you based on things like your income, your credit scores, and how much of a down payment you have. And so whatever you don't put down based on their guidelines regarding your credit and your income, they'll determine how much they will loan you. Then you have to find a house that can be accommodated with the amount of the mortgage that you're approved for, and plus whatever down payment money you have. And so that amount that the bank is actually loaning you for the house, that's your principal. In addition to that, you're going to have interest payments. So the interest is the cost of borrowing the bank's money. This is what they're actually charging you for allowing you to use the use of their funds. And again, the interest can vary depending on where you got the mortgage, what type of institution, and your credit scores, your credit history, your payment history on other bills, your credit history and your payment history with your rent, if wherever you've lived in the past. All of that is going to factor heavily into your interest payment, and your interest payment is going to have a heavy effect on how much your final payment ends up being for the mortgage. So you've got your principal and you've got your interest. You also are going to have to pay property taxes on that property each year. Now, the banks are not going to loan you hundreds of thousands of dollars and then take a chance that the property will be lost to the county because you didn't pay the taxes on it. They're going to, in a sense, insure their property by making sure that the taxes getting paid by usually rolling those taxes into the mortgage. So if you have a $2,400 a year tax bill for the property, they are going to just basically add $200 a month to your mortgage payment, and then at the end of the year, the $2,400 they've collected for you for the tax portion, they will go ahead and send it in to the county and pay your property taxes each year. There are circumstances where you can pay the taxes on your own and not have it be a part of the mortgage, but very often your lender is going to want to have that escrowed into the mortgage payment. That way it's taken care of, they know it's taken care of, you know it's taken care of, and they don't have to intervene with the county because you've gotten behind on the taxes for the property. So generally, taxes are also going to be a part of your mortgage payment, which, like I said, could be a couple $100s a month extra on top of the principal and interest payments. Now, another thing that you're generally going to have is insurance. Because this is a large purchase and you have a lot at stake, the bank has a lot at stake, they're not going to take a chance on losing their investment in your property due to a fire or a natural disaster or even vandalism, anything that could happen to the property to diminish its value or destroy it. They want to make sure that your protected as well as the bank themselves is protected. So they are going to ensure that you have homeowners insurance. In most cases, you can shop around and find your own homeowners insurance, and you report that information, what you've settled on, what insurance you've purchased, to your mortgage lender. And you either can pay that on your own, or it can be added to your mortgage payment each month, and then they will pay the insurance company. Now, if for some reason you let your insurance lapse, or you don't get any mortgage insurance, or don't keep it, this mortgage company will get it for you and automatically add it to your mortgage. A mortgage lender with a significant investment in your property is not going to allow the property to go uninsured. They're going to just get insurance for you and charge you for it, and send it in on your behalf. So that could be another, depending on the property itself and what area you have purchased in, and any particular risks in that area, or risks of you if you've made insurance claims before on other property. Insurance could be another couple $100 a month. It just depends on the property type and yourself. You could also, though, get discounts on insurance if you bundle it with your auto or life or other insurances that you have with the same company. And we talked in previous units about all the other types of insurances you might or should have. So this could very well get bundled and end up being a very reasonable price. But it is something that is going to be in addition to your principal, your interest, your taxes. You also need to consider the fact that there is insurance that's required on the house. So when you talk about getting a mortgage, this is a pretty hefty payment every month. And when you are considering making this purchase of a home, all of these items have to be considered when you look at your total mortgage budget and what you can afford to pay. So let's look at quickly the different types of mortgages that you may have. All mortgage loans are not the same. I always say that you don't ever get a mortgage from a place that has mortgage in their name. If the name of the institution has mortgage in it, they're going to have higher rates. They're a financing firm that may specialize in challenging credit, or people that can't verify their income, or for some reason they take high-risk customers, which sometimes if you are a high-risk customer, that's the only way you can get a mortgage. There's through a company that has mortgage in their name. But it is best, if possible, if you can clear your credit, pay off your old bills, get your background straightened out, that if you can get a mortgage through a regular bank, you're normally going to get the best rates by going that route. But as it is, there are different types of mortgages no matter what institution you get it from. A 30-year fixed mortgage is exactly like it sounds. You're going to pay on your home for 30 years, 360 payments, 12 payments a year. And you're going to have a even payment amount each month. It's going to be a fixed monthly payment for those 30 years. And because you have a fixed rate. Because since your rate is fixed, we can calculate right at the beginning of it how much your payments are going to be from now until the next 30 years. You pay that flat amount. Now, at the beginning of the payments, at the early years, usually about the first 5 years, the majority of that fixed payment is going towards paying mortgage. So if you look at your principal balance, you're like, I'm making payments every month and my principal balance just isn't going down. And it really doesn't go down very much. Very little of it goes towards principal at the beginning. But once you've paid off all of the interest, then at some point, maybe year 6 or 7, you're still paying the same amount per month for the mortgage, but more of that payment will start going towards the actual principal and paying down the balance of the mortgage. You'll also want to, when you sign up for the loan, find out if there's any penalties for prepayment. Like I said, banks and mortgage companies get into this business of loaning money to make money. So they are vested in the interest. They like interest payments. So there could be penalties for you paying it off early and shorting them on their interest. Not always, but you want to check that. See if there's any prepayment penalty. Now, another thing you could get is a 15-year fixed mortgage. These aren't as common, But often they will carry a lower interest rate. It's only financed for 15 years, so your payment generally may be higher because you have less amount of time to pay off that principal, but at the same time, you're paying a lot less interest. A great deal more of your payment from the beginning is going towards knocking the mortgage down, the principal down, rather than just paying off interest for so many years. So that's another type of mortgage that you can look into. Now, what you want to avoid, in my opinion, is the adjustable rate mortgages, or the ARMs. These aren't as popular now as they were maybe 8 years ago. We probably recall when a lot of people with questionable credit were getting mortgages, getting approved, and they were getting approved under these ARMs. And what happened? A couple of years later, a lot of those people were being foreclosed. And the reason they were being foreclosed is because a lot of these balloon payments came due. So balloon payments is a large payment where what happens on the adjustable rate mortgage is they only financed you for a couple of years because they couldn't get you a 30-year loan. So they financed you for a couple of years and said, well, we'll refinance you after the 24 months. So in the meantime, you make your payments on time, you clean your credit up, and then you'll get refinanced. But what they didn't mention a lot of times is that if you don't qualify for refinancing when that 24 months comes up, you owe the whole entire mortgage that's remaining. That's the balloon payment. It's like, we're going to finance you for 24 months and then you pay the whole thing off or get refinanced. And that or part wasn't mentioned a lot of times when people were applying for these type of mortgages. So these balloon payments come due. They don't have $90,000 to pay the mortgage off. They can't get refinanced because of their credit, and so they lost the home that they were so proud to get a couple of years ago. It happened to a lot of people. I think the mortgage industry wasn't as honest with some people as they should have been about the situation they were really getting into. But be careful of ARMs, be careful of balloon payments. In my opinion, you don't want anything to do with either one of those regarding purchasing a home. You don't want ARMs, you don't want balloons. Now, one other thing that you should be aware of, though, is points. Points are just additional fees that are charged up front. They're like processing fees for the mortgage. And so a lot of times they're about 1% of the loan, and it might also be considered just prepaid interest. But with your down payment, sometimes a mortgage company will also ask for points, and these are basically just upfront fees for processing the loan. Generally, if you have excellent credit, you aren't asked for points. If you have maybe marginal credit, sometimes the bank will ask for a point or two of additional fees. Now, some things that will help you are a couple of sites you can look at. I recommend checking mortgagecalculator.org. You can put in information about how much down payment you have and the interest rates currently, and see kind of what mortgage payments would be for you. And then I also recommend checking out bankrate.com/mortgage to find out what the current rates are for 30-year fixed mortgages or 15-year fixed mortgages based on what you're looking for. So this information should just help you get started and understand the basics of mortgages. We'll talk more about it in the discussion area this week. And of course, if you have any questions about the assignments or the requirements, just go ahead and give me an email or give me a call or catch me on Blackboard IM. I'll be happy to talk to you about that. And I encourage you to have a great week. Thanks.